Good afternoon, everyone. I'm Stacy Scott. I'm the Marketing and Client Relations Coordinator here at Wickham Financial and Insurance Services, and I'm also your host for today's webinar. We are so glad that you were able to join us for today's session. Today, Graham is going to start things off by shedding some light and providing some highlights on the recent Secure 2.0 Act. And he's going to provide a brief summary of some of the most notable initiatives in this legislation. And it's going to include a lot of changes for retirement plans and IRAs over the next several years. And then we're going to turn things over to our friend and CPA and tax consultant, John Dickson, who is going to come up for air for a little bit during this very busy season and provide some timely information and tax considerations as that April 15th deadline, or I guess this year it's going to be April 17th since the 15th is on a Saturday. But at any rate, it's quickly approaching. And then, of course, as always, Graham's calendar is going to pop up from time to time. So if you would like to schedule some time with Graham or a member of our team, just click on that calendar and let us know the day and time that works best for you, and we will get that scheduled. And now let's go ahead and get started with today's webinar. Graham?
Hey, thank you, Stacy, and thank you for all of our attendees and everyone being on the call. I don't know if anyone can hear in the background, but this is our monthly tornado warning siren test. But it is timely, right? It's the siren for tax time. So, what a great lead in. But yeah, always an interesting and sometimes hectic, probably more for John than anyone else during this time of the season. But I'll start off, as Stacy said, and cover some things with the Secure Act. But as we kind of cycle through wealth management, we consider, again, for all of our attendees, wealth management kind of makes up 5 different areas: retirement planning, investment planning, risk management strategies, estate planning. So today would be under the tax strategy side. All are equally important. It's important for you to keep more of what you worked hard for, right? So we want to think about tax strategies to keep more, again, of what you worked hard for. So for my section, and I'll cover this, maybe 8 to 10 minutes here. It's basically what Congress has passed. It's basically a follow-up package to the Secure Act of 2019 called Secure 2.0. The new provisions could impact on how you save, how much you can withdrawal, penalties, so on and so forth. And I'll get into that quickly here in just a little bit more detail. But if we kind of start out and we just kind of bullet pointed everything, there is a good bit more detail for everyone who's on the call than maybe I just included. So I might just hit the overview. Any additional questions, concerns, you can certainly reach out to myself, John and his team. We're certainly here for you. I just don't think time will permit, nor anyone would want all those sort of details on every detail on every line item. John, I think the Secure Act 2.0 was, 1,600 pages or something like that?
Yeah, job security for us, right? That's what we always kid around. It's these tax acts are job security. So
right.
I'm sure everybody reads every page of it, right?
Right, absolutely, right? Everyone needs to sleep well at times. So let's start out. They're raising the starting age of the RMDs. So that's happened over the next previous years. It's moving from 72 to 73, and then 2033, it's moving up to 75. Also, John, if you want to add any flavor to anything I'm covering, feel free to jump in. If we think about a reduction in the RMD excess tax, so currently you have a 50% penalty on basically on the amount that you should have taken out that you didn't on your RMD, the required minimum distribution. Now they're reducing that amount to 23 to 25%, further reduction down to 10%. Again, some of these things are going to have a couple more layers to them. We're just trying to be a little more concise for our call. No RMDs from 401k Roth accounts. Higher limits, looser restrictions on qualified charitable distributions from IRAs. So keep in mind, you can make distributions from your IRAs to other charitable remainder annuities, trust accounts, so on and so forth. Want to increase the catch-up contributions. One is indexed with inflation, but beginning in 2025, people aged 60 to 63 will be able to contribute an additional minimum of $10,000 to their 401k and to some other similar plans. If we think about Roth matching contributions, not that your employer didn't match, but maybe it was set aside in a little bit different account. Here they're talking about going right in or just being made directly into that Roth account. Auto enrollment 401ks, I think pretty important to help out with people saving. Sometimes out of sight, out of mind isn't always a bad thing, but beginning in 2025, most new work-sponsored retirement plans will automatically enroll you, and the contribution levels might start out somewhere between 3 and 10%. Now that's going to depend on the bylaws and different things that are going on within the plan, but it looks like they are rolling up and into an automatic savings plan and an increase to that. Emergency savings accounts automatically enrolls workers up to $2,500 or a lower amount if an employer stipulates in a Roth type of account. So again, helping people with a little additional savings from maybe those lower income employers or lower compensated employees. Matching contributions for qualified student loan repayment beginning in 24. We're seeing employers can make contributions to workplace savings accounts on behalf of employees who are still repaying student loans. 529s. I think this is a pretty interesting one. This comes up a good bit. What if I have money in my 529 and I don't need it? I'm not going to use it. My children aren't going to use it. I don't have another immediate family member going to use it. Well, they're saying up to $35,000 can be rolled over to a Roth account for the beneficiary. So if that's the child, or you can name yourself as a benefactor, maybe John can add some flavor to that. I know we've talked about that a little bit when it came out. But it has to be held for at least 15 years before you can do some of that. So you have other options, I guess, long story short.
Yeah, I think that's a great benefit now for taxpayers, where before they might have been hesitant to over contribute potentially to 529. Now there's this alternative method of getting it out and transferred into a Roth for beneficiaries. So I think that's a great benefit for clients and taxpayers to not worry as much about overfunding those 529 plans now. So because there is an $8,000 deduction per beneficiary per year you contribute to those for Georgia. So and then I'll just add, why is some of these important? Obviously, the tax impact of being able to contribute more to your 401k. If you contribute on a traditional basis, that's going to lower your taxable income. So not only are you getting more into retirement, it also gives you the ability to decrease your taxes, and your overall take-home pay won't be adjusted that much because your withholding will adjust too. I think that's what people forget sometimes, that your withholding is a factor of your taxable income. So when you're filling out your W-4 for your employer, that withholding is based on your taxable income. And when you put more in retirement, your withholding decreases, which means your take-home pay will increase. So you can defer to your retirement account and not really change much of your take-home pay. Also, if you're used to doing this, electing the same as last year, you open up your employer website and you're just picking the same amounts, or you're going to miss out on the additions. So you need to make sure when you're doing your elections for each year, you're looking at these numbers to make sure you're maximizing the values, because just because they increase doesn't mean you're going to automatically get increased depending on how you're doing on your employer website or on their paperwork. So just be mindful of that. And I think the other thing with the deferral of the RMDs, we work with Graham and his team a lot for Roth conversions. So by pushing out the RMD a couple of years, it gives you the opportunity to potentially do some conversions, Roth conversions, and pay taxes at a lower rate before you even have to take out the money.
Yeah, no, great points, John. And I think, just like a couple I met with earlier today, we also want to think about multiple buckets: tax now, tax later, never taxed. One, we just don't know where taxes are going to be down the road. But one, from an estate planning, from a tax-free standpoint, conversions, right, can be beneficial. Not to mention, you just don't have to worry about RMDs, doing those conversions over there. So, I mean, I would encourage, as we always do with our clients to consider those buckets. How do you have those buckets filled? Does it make sense for you based on our, and with John and his team's help, anticipated tax liabilities down the road? So I think all good considerations. We'll roll into the new exceptions to the 10% early withdrawal penalty. New exceptions include emergency personal expenses, terminal illness, domestic abuse to pay for long-term care insurance premiums, and to recover from a federally declared disaster. So there's more ways to access without additional penalties. We do have a savers match. Currently, a low and moderate income saver gets a tax credit of up to about $1,000, $2,000 for a married couple. In 2027, the credit will be redesignated as a match contributed directly into an individual's retirement account. John, do you have some flavor on that? Is that just more ways to help out maybe a little bit lower compensated employees to be able to put a little bit more aside for rainy day?
I mean, instead of redirecting that money into their pocket, it's pushing it into the retirement account. So it's helping, again, back to the whole purpose of this is help people with retirement and try to offset Social Security. Instead of giving it into their pocket, they're pushing it into the retirement account.
Yeah, absolutely. And for our viewers, from time to time, my calendar will pop up. Just go ahead if you want to set up a call with myself, or we can redirect it to John and his team. Just go ahead and use that as it pops up. More part-time employers can participate in retirement plans. They usually had to meet a certain guideline. Now they've loosened that up a bit. So now you can contribute now. But keep in mind, even if you're not having the option to contribute to an employer-sponsored retirement plan, does not mean you can't contribute to an IRA or potentially to a Roth on your own. So don't let just the employer plan dictate if you are setting money aside for a rainy day, for the retirement down the road, however you want to define that. All right. Rules for lifetime income products. The IRS eases rules surrounding the following lifetime income products, like withdrawing from retirement plans, savings, retirement savings, lost and found. Surprisingly enough, and I know this isn't new to us, it's probably not new to John and his team. We have a lot of clients that come in, and yeah, you change jobs over the years, and you started out with a little plan or had a little money contributed to it on your behalf, and you've moved on. Life's hectic, you get busy, and you realize that, hey, listen, I think I have something out there. I don't necessarily know where it's at. They're trying to stay some searchable database for some of those retirement plans there, and some added benefits for some military spouses. And again, there's a lot more flavor to these topics. I know we just don't have enough time to cover them in extensive detail, but at least I got you thinking, if nothing else. Right?
Yeah, I'll just add to that the retirement savings, in case people aren't aware, every state has an unclaimed property group. And so you can search that unclaimed property website for things that you might have been turned over, whether it's a retirement account, whether it's a payroll check that was never cashed that they turned over to the state. So every state has a website that you can search that stuff. So no matter if you've been in previous states, you can go to that website and look, and they'll keep a database of it. And I can't remember what the statute is. They'll keep it for so many years, and it gets turned over to the state after a while.
No, that's great information. Yeah, thank you, John. And now that might be a good segue just to introduce you. As everyone may or may not know, this is John Dickson with Hensler CPAs and Advisors. We work closely together from the tax standpoint and advisory standpoint. And John, we're just glad to have you on today. Give our listeners some tips and tricks and considerations as we get ready for tax time. Right?
Sure. Yeah. Thanks for having me. I appreciate it. Well, it's 2023 now, and I know we blinked and it's been a blur, and we're already into the new year. But there are some things to consider. We like to do tax planning in the actual year, not the year after. But there are some things that we can look at and help clients and taxpayers with to help them decrease their tax liability. So we'll start out with the individuals. So when we're working with clients, there's you can have an opportunity after the year to contribute to IRAs up to April 15th. So we can look to see whether or not working with with Graham and his team, whether or not it's beneficial, looking at the different buckets like Graham was talking about, whether it's a taxable bucket, tax deferred, tax never, do we want to make a deductible or non-deductible contribution to an IRA, whether it's a Roth or traditional? Do we want to do a backdoor contribution, put it to a traditional and then convert it to a Roth? So those are things that we're doing after a year in that are still for the prior year. Also with HSAs, if you have a high deductible plan, you can still make contributions for the prior year up to April 15th. So it's a way of putting money into an HSA for medical expenses and taking a deduction for it. And, everybody has different preferences. My preference is to let that HSA grow tax-free. We look at it as another way of self-insuring your long-term care. In paying medical expenses out of pocket versus HSA versus taking the money out of your HSA. Because again, it's like a Roth, it's the tax never. So you can let it grow and never have to pay taxes on it as long as you use it for medical. And so you always have that set aside for that. And then also 529s, as we touched on before, you have in Georgia, for all the Georgia taxpayers in Georgia, you can actually contribute up to April 15th. Well, in this year, it's actually the tax deadline's April 18th. We got the emancipation holiday on Monday, the 17th. So the tax deadline's actually Tuesday this year, the 18th. So you have until the 18th to make contributions to 529 plans in Georgia. Every state's different. So depending on what state you're in, you'd have to look to see if you can still make the contribution for the prior year and have a deduction. But Georgia allows an $8,000 deduction per year per beneficiary for the 529 plans. And again, with the long-term planning opportunities there, with the Roth, contributing up to $35,000 to the Roth, there's really less concern now about overfunding those. You can also use 529s for daycare not daycare, but private school from K through 12. So now you can withdraw up to $10,000 a year for that for beneficiaries. So you get an $8,000 deduction. So we have clients that will put $8,000 in and turn around and take $8,000 out and use it for the private school, and you're getting an $8,000 deduction for it. And you can put more in than $8,000. It's just that's all you're getting the tax benefit for in the Georgia deduction. Also, people tend to forget about dependent care expenses. I mean, it's expensive having children. We always kid around. Kids cost more than their tax benefit. So it's kids for the tax deductions. Kids cost more than the benefit you're going to get from a tax perspective. But dependent care expenses, if you have daycare, you can report the daycare expenses on your tax return. Both spouses, taxpayers, have to be employed in order to have earned income in order to claim the credit. But a lot of times clients will forget about that tax deduction. So I want to remind people to make sure they take advantage of that.
John, quick question on that. Is there income limits on that dependent care expenses?
There's an income limit as far as the percentage of credit, but you can't phase out of that credit. So okay. You can't phase out of the credit, but it decreases. The maximum amount you can get is 20% of what you spend. I think it's $600 up to $600, $3,000 per, and it's changed again last year with COVID. The child tax credit and dependent care expenses credits were inflated because of COVID, and they've brought them back down. So I believe the maximum expense you can claim per child is $3,000 for 20% credit. So it's a $600 credit, maximum credit per child that you can claim for dependent care. But your employer might also have a flex spending account for dependent care. So you might be contributing to that. So you can, I think it's $5,000 maximum. So you can put $5,000 maximum in a flex spending account for your employer. You turn in receipts, you get reimbursed that $5,000. So you're not paying taxes on that $5,000. Then you can report $8,000 of expenses on your tax return per child. You got that $5,000 that you contributed pre-tax already. You have $3,000 that you haven't got a tax benefit for, and you end up with a $600 credit. So in essence, you spend $8,000, you're not paying tax on $5,000 through your employer, and then you can get a $600 credit on your tax return for it. So it's a nice benefit for clients, with the amounts of money we spend these days on dependent, childcare.
Yeah, I think one other thing I'd like to add to this, not one of these might move the needle a lot for any one household, but it might be a combination of a little of all these things. So a little bit can add up to a lot. So keep that in mind when you're thinking about your HSA contributions, your 529 contributions, especially, and sorry to step on your toes, John, especially in the higher income brackets, right? Take advantage of where you can. It just adds up.
Right. And especially when we talk about the number of years you're doing this. I mean, if you're, and you see it a lot in the power of, growth in portfolios, right? When you're talking about, a percentage of return year after year after year and the compounding interest and all that, the impact of that same concept. I mean, you're doing this stuff every year over a course of 30, 40 years. I mean, the benefit's tremendous. If you look at it of 1 year, yeah, these numbers might not seem material, but when you look at it over a long period of time with the impact it has on your overall growth of your net worth, I mean, it has a tremendous impact on it if you're doing it versus if you're not doing it. So it's a good point that, looking at it, $600 right now doesn't seem like a lot, but over the course of 18 years, if you're spending it and what's the benefit of that $600 over the course every year compounded after growth. So right. it has an impact over the years. And then finally, the last thing for individuals, we always tell clients to look at your credit card summaries. It's a lot of times over the course of the year, there might be times where you contribute to charities, you put it on your credit card or something, and you're not thinking about it. It's always good. Most credit card companies now send you a year-end summary where they have different categories. It's just something quick and easy you can do to make sure you're reporting all your deductions. If you're a business owner, and we'll go over this a little bit more detail for the business owner, but it's just a good way, a summary, just looking at your overall snapshot of your expenses, where you might be spending things that might have a tax impact, whether it's, you paid your property tax bill or your dependent care. It's a good snapshot of what you spent money on for the year, and if anything in there is tax deductible.
No, great point. Okay. Do you want me to change this for you, John?
Sure. Yeah. Let's go to the next slide. So there we got the business from the business perspective. And again, you got individuals that are also associated with business. So that's why I mentioned with the credit card expenses. Since we just talked about that, I'll go ahead and jump to that reimbursement of expenses one. The second one down. It's a lot of times in the busyness of life, you might pull out your wrong credit card and charge something personally that should have been a business expense. So go over those credit card statements as a business owner and see if there's anything on there that should be recategorized and have the business reimburse you. It's an easy way. I mean, it takes time, but it's an easy way to bring your taxable income down. Missed expenses is usually the number one way of saving taxes, is go back over, the course of life and see what expenses did you pay personally that should be categorized as business expenses. And home office deductions, another one that a lot of people miss out on. W-2 employees, not really a deduction for W-2 employees, but for business owners, the business can reimburse you a percentage of what you're paying for use of your home office. So good way after the fact to decrease your taxable income. And of course, segue from the last section that Graham talked about with the changes in retirement plans, SEP IRA and 401ks. Those you can now do 401ks the year after the tax year. So used to, in previous years, you'd only be able to do a SEP IRA after the fact. So now that we're in 2023, if a client came in and said, hey, I want to do a retirement plan, I want to contribute for prior year, the only option would be a SEP IRA, which is really a minimal amount. It's just a profit sharing. It's 25% of your earned income from that business. So if your wages are 40,000, then you'd be capped at 25% of that 40,000. So if you're a Schedule C, then it'd be 25% of your after self-employment tax net earnings. So there's really a cap on that. But if with a 401k, you have the employee deferral plus the employer deferral. So you have a way of maximizing your contribution to 401k in excess of what you would be allowed for the SEP IRA. So now with the new laws, you can set up and contribute to a 401k for prior year. So that's a great benefit for clients, being able to establish those plans and contribute. And there's probably usually half a dozen to a dozen. We usually walk through that process every year, where they haven't been doing it. Now they have a good cash flow to do it, because it really comes down to your cash flow, right? You're taking money out of your left pocket, you're putting it in your right pocket, and you're taking a tax deduction, but you really don't have access to it, in a retirement plan like you would if it was still in your business account or your personal account. So it usually comes down to cash flow for that perspective, but it's a great tax saving opportunity. For business owners who have acquired property, or whether it's real estate or equipment, things that we help clients with: cost segregation studies. If you've acquired real estate, that's a way to recapture vast amounts of depreciation expense in the year of acquisition. So that creates a great benefit for clients. That's something we're doing in 23, ultimately for 2022. And bonus depreciation versus 179 tax deduction. Again, these are just little tax things that we can help assist clients with. If you've acquired property, whether it's a vehicle, whether it's machinery and equipment, things that help you on your taxes, that from a timing perspective, we're looking at it in 23 and it's something you already did in 22, but we're helping you from a tax perspective to maximize your benefit. If you're an accrual-based taxpayer, we could actually help you calculate accrued bonuses for the year. Cash-based, a lot of taxpayers are cash basis. So really, from a business owner, you're taking deductions and you're reporting income based on cash. If you receive your income, you're picking it up and paying taxes on it. If you're paying out an expense, you're deducting it. Well, for an accrual, you can accrue bonuses that someone might have earned for that prior period. And if you're paying it out with 2.5 months from the year end, so you'd have an ability to accrue a bonus as of 12/31, and then pay it out by 3/15 and take that deduction for the prior year. So we've actually had a couple we worked through that with this year, providing the extra benefit.
Excellent.
So those are just a couple of little quick reminders for what we help clients do here now we're in 2023. And then, of course, when we were working through last year, we also look forward and what we can do going forward in 2023 as well. So,
excellent. Thank you, John. Stacy, do we have time for questions?
I believe we do. We have a few questions that have come in. First of all, I believe this is for you, John. Are there any special considerations or tips or tricks that specifically for high net worth clients or businesses?
Well, high net worth businesses and individuals, I would say, looking beyond the SEP IRA and 401k, I think you have other opportunities for retirement plans that can maximize your tax deduction with cash balance plans or a popular structure, I think. But that what we use, you also have donor advised funds that you can be utilized. So there are some other things, I guess, that you can focus on for high net worth individuals to help save taxes. Most of those are things that you're doing during the year and not after the year. But yes, there are ways that we can help clients set up strategies for tax savings going forward. But those aren't really things you can go back and do for last year. But yes, going forward, there are some things that we could do.
Okay. And Graham, I think this one is for you. With all the volatility in the bond market and interest rate increases, are bonds and the like a good place to invest right now?
Well, I think it's a lot better than it was, right? I mean, we're in an environment of basically free money, and we're just not in that environment anymore. The Feds had to raise rates pretty dramatically. I mean, that's probably an understatement, right? To try to get inflation under control. It's probably going to stay higher for longer. So your money markets, your savings rates, your money market funds, your CDs. Listen, if you're not getting 4%, 4.5%, at least 3% on those ultra safe conservation type products, you need to reconsider that. It's available, right? Think about it over the last decade. If you really couldn't get any interest, real return on CDs or savings account or money market accounts, then you were forced to take on a lot more risk with the stock and bond market. That's just not the situation now. So I think you just have more options for your ultra safe money as well as the bond market. listen, the bond market probably faced its worst performance ever in history. Only other time that we've had stocks and bonds go down like this together was about 45 years ago. Very rare occurrences, right? So it's not a guarantee of positive performance, but boy, it does set you up from a great risk reward. And now you can get paid with possible and what we feel great capital gain opportunities.
All right.
Yep.
Okay, John, I have a fun one for you. I just bought a golf cart. Can I deduct it?
Well, in order to deduct it, you have to have a business purpose for it. So I guess it depends on looking at your overall bit. If you have a business as an individual, no, you can't deduct a golf cart. There used to be credits years ago if you bought an electric vehicle that was qualified to be on the road. Most of those credits now are moved along to more expensive type of EV vehicles versus the electric golf carts. Unfortunately, it's the answer is probably no.
Right.
Okay.
Great question, though, Stacy.
I thought so. Okay, well, thank you so much, guys. And obviously, this was great information to hear as we inch our way closer to that tax deadline. And thank you to all of our viewers who have joined us today, and for those who sent in those questions for us. Remember that you can get current market updates from Graham every Monday on our weekly wrap-ups. So please tune into those to get the latest and greatest information on what's going on in the market. And then also, I want to take this opportunity to let you know that next week we're hosting our next retirement planning class for this year. And this multi-day comprehensive course, and really, I mean, no matter where you are in your retirement planning journey, you're going to find some information that is super beneficial to you. So if you or someone you know is at or nearing retirement age, please have them to join us in class. And one more announcement, we have the newest class that we are offering here in our in-office classroom. We have it scheduled for Thursday evening, March 16th, beginning at 6 p.m. And our team is going to host a class on opening a business. So I know that many of our friends and clients have these amazing business ideas, and they just don't know where to begin and how to get started to implement those ideas and get that business up and running. So if you or someone you know fits that description, this is a great opportunity for you. Graham and our team are going to provide some insight and some considerations on this topic. And this is a special opportunity for our clients and their guests. So we're providing it free of charge, and we would love for you to join us. Reach out to us for more details. And I guess that's it. So thank you so much again for joining us today. Thank you, John and Graham, for an informative webinar today, and hope everyone has a great afternoon.
Take care.
Thank you very much.